Navigating the rules that govern modern banking can sometimes feel overwhelming, particularly when dealing with digital transactions, debit cards, and automated payments. For individuals utilizing consumer deposit accounts, federal consumer protection laws provide a critical safety net that dictates how financial institutions handle electronic fund transfers. Understanding these legal frameworks is essential for safeguarding personal finances against errors, unauthorized access, and processing mistakes. Federal guidelines ensure that consumers maintain clear rights and predictable liabilities when moving money electronically. At the core of these consumer safeguards is Regulation E, a federal rule implementing the Electronic Fund Transfer Act. This regulation outlines the baseline responsibilities of financial institutions and establishes concrete protections for account holders engaging in electronic banking. TotalBank, like other regulated depository institutions, must operate within these federal parameters to ensure that consumer asset accounts, such as checking and savings accounts used primarily for personal, family, or household purposes, receive standard legal protections. Electronic fund transfers encompass a wide array of everyday financial activities. Covered transactions include automated teller machine withdrawals, point-of-sale purchases made with a debit card at retail locations, direct deposits of payroll or government benefits, and recurring automated bill payments. Furthermore, telephone-initiated transfers and electronic check conversions where a paper check is processed as an electronic debit are generally included under this umbrella. Business accounts, commercial banking products, and wire transfers processed through Fedwire are typically excluded from these specific consumer rules. One of the most vital components of Regulation E involves limiting consumer financial liability when unauthorized transactions occur. If a debit card or access device is lost or stolen, the financial liability of the account holder depends heavily on how quickly the incident is reported to the institution. When an unauthorized electronic fund transfer happens due to a lost or stolen card, reporting the issue within 2 business days caps the consumer's maximum financial exposure at $50. Failing to notify the bank within that initial 2-day window can cause liability to increase significantly. If notification occurs after 2 business days, but within 60 calendar days of the transmittal of the periodic account statement showing the unauthorized transfer, the consumer's liability can reach up to $500. Moreover, if an unauthorized transaction appears on a monthly statement and the account holder fails to report it within 60 days after the statement is sent, the consumer could face unlimited liability for subsequent losses occurring after that 60-day window. Different liability rules apply if an access device was not actually lost or stolen, but an unauthorized electronic transfer still occurred using account information. In scenarios where an unauthorized charge appears on a periodic statement without the loss or theft of a physical card, consumers are generally protected from bearing any financial loss, provided they report the discrepancy within 60 days after the transmittal of the statement. This distinction provides an important layer of defense against data breaches and compromised account numbers. Error resolution is another heavily regulated area mandated by federal guidelines. When a customer identifies a mistake on their periodic statement, such as an incorrect transfer amount, an omission of a valid transaction, or a completely unauthorized charge, they have the right to initiate a formal error resolution process. Notice of the error must typically be provided to the financial institution within 60 days after the transmission of the statement where the suspected error first appeared. Upon receiving notice of an error, the financial institution is legally obligated to investigate the claim. The bank generally has up to 10 business days to complete its investigation and determine whether an error actually occurred. If the institution requires more time to review the details, it may extend the investigation period up to 45 calendar days, or up to 90 days for certain point-of-sale or foreign transactions, provided it issues a provisional credit to the consumer's account for the disputed amount while the investigation remains ongoing. If the bank determines during its investigation that an error did occur, it must correct the mistake within 1 business day of making that determination. The institution is then required to report the correction results back to the consumer in writing. If the investigation concludes that no error occurred, or that an error occurred in a different manner than reported, the bank must provide a written explanation of its findings and notify the consumer before debiting any provisional funds that were previously credited to the account. Transparency and disclosure requirements form the final major pillar of these consumer safeguards. Financial institutions must provide clear, written initial disclosures at the time an account is opened or before the first electronic fund transfer takes place. These disclosures outline the types of electronic transfers permitted, any applicable fees or transaction limits, the methods for reporting lost cards or unauthorized actions, and a summary of the consumer's rights regarding error resolution. Banks are also required to supply periodic account statements for any month in which an electronic fund transfer occurs, providing a clear paper trail or digital record of all activity. Additionally, if a financial institution plans to make adverse changes to terms such as fee structures, transfer limits, or liability rules, it must deliver a change in terms notice to consumers at least 21 days before the modifications take effect. Together, these regulatory mechanisms ensure that account holders maintain transparency, accountability, and dependable financial protection across all electronic banking channels.